So this is part 2, a continuation from the video of what the break in market structure. Right now we are back and we are continuing to what supply and demand or order blocks, right? So an order block in smart money trading is a price where institutional traders place significant buy or sell orders, often marking origin for strong market movement. It represents a consolidation or reversal area that acts as a magnet for price action, serving as support, bullish or resistance on a bearish market. So below is a concise structure or example right there. So what usually happens is that a price creates a high, then it creates a low, then after price creates a high on the low right here, you can see that price moves above that previous high. After price that moves above that previous high, it usually comes back to the low that created that break in market structure, and that low that created that break in market structure, that's the one that we call the demand right there. So you can see right here, the demand is going to be what the last down close candle right here. You can see this one, it represents what the demand only. We'll get to the part where we cover what supply. So the demand is going to be what the last red candle before price created the break in market structure. What you usually expect is for price to retrace to the bottom right here, where the red candle, the last red candle can be found right there. Then it retraces into that before it continues right there. You can see as price creates what this demand pattern, it creates highs, then it creates a low, then when it moves right there to break market structure, it creates a higher high, then it retraces into the demand to create what a higher low, then it moves right there to create another break in market structure, then it creates another higher high. Right there you can see a demand right there, and we can see price had created what a high right there, then price had created a low right there, then we see that price moved above that previous high right there. After price moved above that previous high right, we expect for price to create a retracement into the low that created the break in market structure right there. And that break in market structure, that low that created the break in market structure, it is the one that we assume to be the demand right there. For another context, we can say that there was a movement between a resistance and support right here. Then this support had more power to break what the resistance that was resting right there. That's when we expect, when price comes back to this demand zone or this supposedly support zone, to push, because we assume that it has more power because it was able to break a structure. Then we can see that after price created the break in market structure, it retraces right there. Then where do you enter? You enter exactly at the open of the down close candle, then your stop loss below the previous low. Then for supply right there, we have to see a low and a high created. Then what does price do? Price creates a high, then it quickly moves below a certain low, a break in market structure happen. What do you expect? You expect for price to retrace to the high that created that break in market structure. Exactly at the high that created that break in market structure, we have to see that price reject or continue to the downside. So you can see that after price created that high, it had a low, then when a break in market structure happened, a lower low was created. When price retraces into the supply right there, what does it create? It creates a lower high because that was a previous high. Then after it drops right there, it drops to create another break in market structure, then to create a new lower low. Then another illustration right here, you can see this is a supply illustration. There is a low right here, there is a high, then price moves below a certain low. What does it do? It is going to retrace to the high that created that break in market structure right there. That's when supply is, you can see on the after part, price retraced into that high, then it completely delivered to the downside to create another lower low. On a real life chart, let's look into the chart right here. We can see there's a high, there's a low right here. We can assume that a break in market structure happens when price moves above right there. Then we must mark what this low right there that created our break in market structure to be what our demand. So what usually happens is that we expect for price to retrace back into the last red candle right here on the movement that created that break in market structure, and we are going to target what the previous high right there. So what does price do right here? After it creates a low, it creates a higher high, lower high, then a higher high as well. Higher low right there. So on a real life chart right here, I'm going to show you what there is a difference between a break-in structure and a liquidity sweep. So look at the structures right there that you can see. We can see that price moved above that previous high. You can see there's a high right there. There was a move above that previous high, but there was only a wick outside, so we do not consider that as a break in market structure. We can also label that as a what, as a liquidity sweep or something. But let's look when price was moving what, below that certain low right there. When price was moving below that certain low, what did happen? So let me just finish up labeling this so that you can understand. So now you can see there is a low at the bottom right here. There is a low right there. This is different because we can see that when price was moving now to the lows, it created what, a close below the low. This one there was no closure. You can see that there was only wicks above that high. But then when you see in a bearish market right here, you can see that there were completely candles that closed below the certain low. So a breaking market structure only happens when price closes above or below a certain low, not this one. So if you see wicks only above that, you can consider liquidity sweep. Now back on context of supply and demand, we can also now assume that now that price created a high right there, it created a low, then it created another high right there. We can now say, okay, the break in market structure happened to the downside. What do we expect? We expect for price to go back to the high that created that break in market structure right there. So what you need to understand is that on a supply, we take what, the last blue candle on the movement that created the break in market structure, and that last blue candle is going to be what, our supply right there. So where do we enter? We enter exactly at the open, or where the rectangle starts right there. Then when we stretch our chart right here, we can see that price usually comes back to retrace into the structure, then it completely moves right here. Then for context of structure, we can say this is a low, this is a high, this is a lower low, this is a lower high. Then price moves to create what, another lower low. So let me also look for another quick example right there. So you can see again from this another example, we see that there was a low right there that was created, then price moves below that certain low. What happens right here? That was a break in market structure to the downside. We expect for price to retrace to the high that created what, that break in market structure. Then you can see right here there are completely this complete confusion between 1, 2, 3 structures. Then you can take what, the one overlaying to the highest, then you can use that type of candle. Then we expect for price to retrace back to the high that created that break in market structure, and that's what we call the supply. You enter right there, your stop loss above the high, then you target what, the previous low. I hope you like that video. Make sure you follow us, like there's a part 3 of this video. Make sure you check it out. That will be on what, inducement.